Good to go?
Yeah.
All right, thank you, everyone. Appreciate you sticking it out to 3:15 on a Tuesday in Vegas. Been in the room all day, so hopefully we'll keep it light and interesting. My name's Chris Mitrovich. I'm a director of client relations at Zeiss Group, and we're excited to cover a pretty interesting topic, which are challenges funds face when investing in structured products. We'll predominantly talk about CLOs, mortgage-backed securities, and asset-backed securities and different types of fund structures. We have a really great panel, get a lot of different diverse perspectives on the markets and the challenges that we're all facing. So before we get started, I'll ask the panelists to introduce themselves.
Great. My name is Kevin Bliss. I'm with Boston-based NEPC. We're an investment consulting firm representing about $1 trillion over 300 individual clients. I cover structured credit and corporate credit there. I'm happy to be here.
Hi, I'm Andy Mandel. I'm a partner at Dentons, a tax partner. I cover all areas of structured products, and I chair the SFA Tax Committee.
I'm Paul St. Lawrence. I'm a partner at Morgan Lewis in the Structured Transactions Group. I do a variety of things. I focus a lot on the CLO market, both in the BSL and a little bit in the middle market space. Also do a fair amount of work in the residential mortgage space and a variety of other interesting products.
Thank you. Amit Thanki. I'm a portfolio manager at the County of San Bernardino's public pension plan. We're an $11 billion plan based out of San Bernardino, California. I'm a generalist portfolio manager, so I cover the entire gamut of portfolio classes that we have available to us. Thank you.
Great. Thanks all. So I guess starting at a real kind of general level, how are allocators and issuers, from your perspective, thinking about the credit market as a whole? And we'll start there and kind of dive more deeply into structured credit.
Sure, you want me to go?
Yeah, Kev.
All right. Yeah, I mean, I think it's important to start at a high level and think about where the credit markets are today. And, there's trillions of dollars in negative yielding debt out there. You have this almost daunting overhang of triple Bs over the high yield market. And we've seen continuous retail outflows from the loan market for a couple of years now. And with these headwinds in mind, we're really trying to find, areas of the market where investors are being compensated fairly for the risk that they're taking. And I think, in the structured credit space, you still have areas and pockets of the market where you can be fairly compensated for the risk that you're taking. Some of the trends that we're seeing in the CLO space, and I think we'll get into this later, but there's been an influx of new managers in the space from both a collateral standpoint and an investment standpoint, and that brings in some really unique challenges from an allocator standpoint. And then in the structured credit space, we've seen a lot of managers continuously creep out on the liquidity spectrum to try and pick up juicier yields, and that's something that we continuously face too, is trying to understand kind of the asset liability mismatch that can occur when you creep out on the liquidity spectrum in some of these funds that have quarterly or semi-annual liquidity.
Just thinking about it from an investor's perspective, the question I always go back to is, how did we get here? 10 years ago, my portfolio was 60% bonds. Today, that's not investable. It'll never help me get to my assumed rate of return. So where do I go looking for yield? And credit's one space that continues to have pockets of opportunities. These pockets used to be pretty big, and now they're really tiny, full of holes. So, we are in a market today where we feel, as an investor, you have to be tactical, you have to be nimble and able to take advantage of the moves that happen. You also have to be thinking about it not necessarily from a long-term holding perspective, but much more of a trading mentality, because the underlying standards that define these assets are perhaps not as robust as everyone would like them to be.
And I think the other way to think about trends in this space are asset-specific trends, because we were talking about investing in structured products. We're talking about investing in, It could be CLO securities, it could be RMBS securities, it could be a fund that's investing in whole loans of different types. And each of those asset classes have their own kind of hot button issues or market trends that you need to be thinking about when investing in this space. So for example, one of the trends that we've been seeing in the CLO market generally is managers raising kind of new generation equity funds, which is a trend that kind of initially started when people had to come up with risk retention solutions a few years ago. And even with most BSL securities, CLOs no longer subject to U.S. risk retention, the process of coming up with these risk retention solutions offered a new strategy as well for kind of having captive equity investors for their own deals. And so there's a number of managers who, despite the fact they don't need it for risk retention anymore, are looking to build funds that will then invest in their own CLO equity and potentially CLO equity of other managers to kind of keep a little more diversified. And so if you are invested in a fund that's looking at investing in structured products, that may be something that may be presenting opportunities to kind of go alongside with managers on those types of strategies. In the mortgage world, they have its own trends in terms of the different strategies that funds that are investing in residential mortgages are taking on. The market's going through a bit of a transition where there was a long period of time where there's a lot of popularity in investing in RPLs and MPLs, and those opportunities are kind of winding down, and people are looking at what's going to be the next opportunity. Is it going to be more not conforming jumbo loans? Is it going to be some of the loans that would normally go into securitizations that were exempt from risk retention that may not be in the future? And so they're seeing new opportunities there as funds are trying to think of what their next steps are. And again, that trickles down if you're investing in a fund that's looking for opportunities in structured credit.
Andy, anything?
Not yet.
So we spoke about the trends. I think it's important to really focus on how we're adapting to those trends. Amit, maybe start with you as someone who oversees $11 billion in pension assets, and how are the folks at San Bernardino kind of adapting to those trends and trying to look ahead?
Sure. We're asking a lot more questions to begin with. So I think, one of the advantages that we have is we were early into the credit market, so it's allowed us to develop our relationship with our counterparties, which also happen to be the asset managers, and develop these relationships to a level where these are sort of customized solutions rather than a fund product. So as a result, what we have done is identify managers who have broad capabilities, whether it's in credit or structured credit space, identify the areas of their expertise, and effectively give them guidelines that allow them to move within those buckets as they see opportunities come up, rather than defining those opportunities by percentages or numbers. What that has allowed us to do is take advantage of dislocation. So when the CLO market sold off at the end of 2016, we basically had called up all our managers and said, buy as much CLO paper as you could, because we understood what was causing the contagion in the CLO market was coming in from the high yield market and the energy space. We knew the CLOs themselves didn't have a whole lot of energy exposure, so the paper was reasonably good. It was a matter of mark to market that was happening, and so we were able to take advantage of that. But you cannot do that if you are in a fund structure or if you have constraints with your managers on their SMAs. So that's one thing we've done. The other thing that we've taken into account is managing liquidity, because that is paramount to a pension plan. The biggest function I do every month is making sure the pensioners get paid. The second they don't get paid, I lose my job. So that's one thing I need to solve for, and making sure I have liquidity within the portfolio, not only just to pay out the pensioners, but also to make sure that I am able to fund all these opportunities as they come by. So as a result, we do run a pretty decent sized balance of cash. I know a lot of people have different opinions on how cash is to be utilized, but we think about cash as having a lot of optionality value. It's something that you cannot do with other assets that may or may not have liquidity. So those are two things that we use, and we have learned to optimize the usage of those to effectively solve for this issue with how to play the credit markets as volatility has come in through the participation of new entrants as far as investors go, new managers who are coming in. As we've seen, there are more CLO managers today than there have ever been. And you see prices seem to have a lot more volatility on a day-to-day, month-to-month basis.
Kevin, how do you think about underwriting new managers in the space? I mean, you guys obviously have hundreds of clients, and you're trying to identify opportunities that are, fit a wide swath of folks. So how do you guys go about thinking about that?
Sure. I mean, I think it's important to bifurcate kind of between CLOs and multi-sector structured credit funds because they serve two different purposes in a portfolio. They have different liquidity mandates and really return targets as well. On the CLO side, we've been much more opportunistic. So if you think back in 16 when double Bs blew out, that was kind of a trade, but not a lot of our clients, other than the ones with scale like SB Sarah, could really take advantage of that. So on the CLO side, we've preferred kind of open-ended funds or even drawdown funds when it makes sense, but certainly lower on the capital stack in the CLO equity space. In the structured credit, the multi-sector structured credit space, we like managers that have expertise across mortgages and asset-backed securities, a little bit of corporate, and certainly some CLO capabilities as well. One thing that we take caution on, though, and we've spoken about this a little bit, but in a commingled product with quarterly liquidity, just making sure that you're managing your CLO exposure wisely, because I think given where we are in the credit cycle, a lot of managers right now in their kind of hedge funds could get very easily burned if the tide changes.
Paul, Andy, anything on adapting to kind of these trends?
Well, I think one of the things it brings up is, from the perspective of somebody who might be looking at investing in one of these funds, really kind of understanding what their overall strategy is in terms of how they're getting exposure to these different products. And one of the things that Kevin touched on is being nimble and to being able to take advantage of opportunities when the market moves in a certain direction. There are also a number of funds out there that will the way they'll invest in a structured product is at the new issuance stage, and understanding if that's how they want to attack their investment strategy. Are they going to be taking controlling positions in these vehicles where they're going to want to have a lot of input on the terms of the securitization or structured product itself, or are they taking smaller positions where they're really going to be kind of a terms taker? And both strategies obviously can work, but it's more understanding kind of what direction they're going to be going in, because if they're going to be taking a control position, that's obviously not something they're going to be wanting to move out of really quickly when the market adjusts, but it may give them the opportunity to customize their holdings in a way that's more consistent with their overall strategy. So it's just being conscious of what those approaches might be as you're looking at different options.
Yeah, and the one thing I'd really like to add is you need to know who your investor is and what their risk tolerance is. So, for example, if you're a super tax exempt, you can have a whole lot of management and control, and you don't have to worry about UBIT or trader business. But if you are a fund that has non-U.S. investors, you're not going to be able to retain the same type of control and escape U.S. taxation. So, a lot of times people come and they say, we want to do exactly what X did. But, X is either a super tax exempt or they're a REIT or they're, not every investor is the same. And so you have to really understand the risk tolerance and your tax position before you can say, yeah, we're going to copy this structure. And as we know, no structure is exactly the same. Even if they say we want to do it just like X, there's always, a lot of changes along the way. So you need to really understand, where your sensitivities are on the tax side before you pick how much involvement you actually going to have in a structured product.
I think it's interesting too, just touching on that away from the tax angle, but Amit, you might have some opinion here as well, but from a marketing standpoint of, marketing from a CLO manager's perspective, you really need to understand who your target is for your fund, and the shotgun approach that works in kind of the hedge funds or even the public market space really doesn't work in CLOs, I find. It's incredibly relationship driven. And you mentioned, Amit, that there are more CLO managers out there today than there ever have been before. We've been active in post-crisis CLOs for 8 years or so now. And we develop relationships over time, and we have all these new players in the space that, are kind of trying to win our business and don't understand that these things take time.
Right. No, I would agree. I mean, the one thing investing in CLOs over the last 8 years has taught me is that it's always a good time to be a CLO manager, but not always a good time to be a CLO investor. And that's a mantra you have to live with, because CLO managers get compensated on the number of CLOs they print, versus investors get compensated on their final return. And as we've seen over the years, being an equity investor, we've seen where returns have come down for equity investors, and sometimes they're down to a high single digit, but that's not where we underwrite CLO equity investing to generate returns. So.
Maybe sticking to structuring, but from a little bit of a different angle. Amit, I think SB Sarah has been really leaders in structuring manager relationships, not only from alignment of interest, but also fees.
Sure.
So maybe give the audience, I know it's our favorite topic as an investment manager, but
Sure.
Maybe give the audience a little view into how SB Sarah thinks of setting up relationships with investment managers.
Sure. Look, I think what we try to do is be fair with the managers on fees. Our fees are necessarily designed to help the managers and us have a better alignment, as in they participate in the performance of the account only after they've hit a certain return requirement. So there's always a hard hurdle. It's not a pref. There's no catch-up. Also, that we pay fees on invested capital. We will never pay on committed capital. That's another feature, but that's usually not an issue with credit strategies. And finally, it's sort of looking for the sort of silver lining where we're able to entice the relationship not purely on the basis of how much money we'll make the manager, but also the ability that we provide the manager in running their business effectively, being a good partner and coming to the manager when assets are selling off, and being a willing buyer to take down good assets when others are looking for liquidity or looking to hit the front door. So we have sort of offered it as a combined package to our managers to, from a fees perspective. Finally, also, I think the one area that we've tended to focus on recently is on the risk retention. I'm not sure if that's where you were going with this, but risk retention has been a good solution for managers to find a captive audience to effectively print their CLOs. We think that those risk retention vehicles can be beneficial. They allow the managers to run their business, but we also think it's a partnership. So where we have, going forward, basically partnered with managers who are willing to do this, where they share the fees on the CLOs that they run. In addition, we have minimum requirements where they have to hit a certain hurdle to be able to print their CLO, or else they're not going to be printing that CLO. So this is after a few lessons learned where, we as equity investors were looking at a 9% return, and that was not nearly what we thought we should be getting. So underwriting assumptions, full transparency on where they're placing these, what are the return expectations. We're certainly asking a lot more and asking a lot more of them as well. So.
And also, I think on the structuring side, what you've done in MCAs
Sure.
Has really helped on the governance side and letting you guys be more opportunistic, even as an $11 billion pension fund.
Right. So with our MCA accounts, or these are sort of customized SMAs, where the investment staff actually goes thumbs up or thumbs down on these investment decisions. So effectively, our managers will come to us. If they want us to purchase their CLO paper, if it's a primary issuance, they need to tell us what the paper is, what are the expected returns, the underwriting, and typically they'll be willing to sell it to us at a decent discount. So we will effectively say yes or no to that. These are discretionary accounts that we run that have allowed us this level of flexibility. Going back to that example of 2016, where we basically gave the managers a blank check, saying go buy as much CLO paper as you can find equity. That was one of the flexibilities we have with our managers, Zeiss being one of them, where we were able to call up Christian and say, what are you seeing in the market? What's causing this? It sounds like a good idea to go buy some more. And so they were able to transact and participate in those transactions. So.
Kevin, kind of same question, but a little different from your seat when you're kind of talking to every manager in the space. So are there kind of must-haves or do's and do-nots that when you're underwriting different vehicles or?
Yeah, in terms of terms and fees, we're pretty flexible on fees. I think the great thing about being a consulting firm is that we have access to so many clients and quite a bit of their assets, both discretionary and advisory. And that really gives us kind of the potential size and scale to get fee discounts for our clients. If we hit 100 million, if we hit 200 million, what will fees look like? In terms of fund terms or manager terms, we always look for key person provisions. We want as much protection there for the LP as possible. And I think going back to kind of my earlier comments about asset liability mismatch, we want to make sure there are hurdles or hard caps in place for funds that can't invest X amount of percent in CLOs or whatever you may want to stipulate there. But I think in terms of the fees, one concerning trend that we've noticed with managers is they'll be lowering their headline fees. So that is great marketing for them. Hey, we used to charge 2 and 20, but now we charge 1 and 15. But they're passing through a lot more expenses to the LPs. And we've even seen some managers that have come out on top, and at the end of the day, they're making more money than before they lowered their fees. So that's something that I think our operational due diligence team has spent a lot of time badgering managers over the past couple of years. It's a trend that we've seen.
Great. Maybe shifting to the legal side, Paul, what are some things or strategic issues that investors should be thinking about when looking at kind of a new structured credit fund?
Well, we touched on a few of these earlier, but I think one of the themes that a number of people have alluded to is you're still looking at some of these investments in the context of the risk retention rules, both because not all while BSL CLOs are largely outside of that regulatory scheme, given the LSTA decision a year ago, the lot of other asset classes still are subject. And in fact, if you're investing in vehicles that are middle market CLOs, you in most cases are still subject to those rules. And that presents opportunities for folks that are looking to invest in structured funds because managers are out there trying to raise equity capital for those deals. But it also provides some constraints. If you're investing in a risk retention fund, you have to understand that that fund obviously is going to have to hold that position for the required period of time under the rules. And so it's not going to be as nimble, to use Amit's word. The other constraint it provides is if you're just in that same space where risk retention does apply to that structured product, the opportunities to buy control positions at those deals are going to be limited, because if the manager or the sponsor strategy is to do it with the horizontal risk retention, they're buying the control position. There are workarounds for that. People will enter into side letters to manage some of the control features in the deal to give them the ability to either block certain actions or to direct certain actions if they're important to them, despite them not holding a numerical majority of the control class. But it just makes the investment decision a little bit more complicated, and you want to be sure that the manager of your fund is sensitive to those and is thinking about those if it's important to their overall strategy. The other overlay on this too is if you have structured products that want to market themselves into Europe, risk retention is still an issue there, of course, and so that's a different pathway of kind of getting to some of the same constraints. And so those are some of the kind of legal ramifications that the regulatory overlay is still implicating in these markets.
Yeah, and the only things I'll add, from a tax perspective is A lot of investors want QSIPs, they want things on DTC, they don't want K1. Some investments, depending on how low, require a K1, there's not as much transferability. So you have to just kind of understand when you invest in that, certain investors may not have the same tolerance to, especially K1s as they do for any DTC bond.
Right, we see that, and there's different strategies for dealing with, essentially kind of getting passed through non-entity level taxation treatment. A lot of vehicles are put offshore for that purposes, but there are a lot of vehicles that end up onshore for other tax and regulatory reasons, and those are issues to surface early on. When figuring out either the structure you're going to use for your transaction, or if you're on the investor side, whether this is even something that's going to fit with your needs. If you engage early enough, there may be ways to meet everybody's list. But it's something that's if you find out late in the game that it's just not going to work.
Which happens.
That's a tough one to deal with.
Andy, on sticking on tax. I know during our prep, we talked about some newer instruments that are, and types of investments that are out there. Any thoughts for the audience on tax
Sure.
treatments there and
Yeah,
what they should be thinking about?
Traditional debt, traditional MBS, ABS, those are really easy assets to understand. But what we're seeing now are these hybrid instruments that aren't necessarily debt, but they may not be equity. For example, ISAs, income sharing agreements. Those are becoming pretty popular where an institution, not like a four-year college, but for a plumbing school or electric school, and they invest in these people's education and they get a percentage of their earnings. Those things are really tricky to structure because there's not a lot of guidance on what they are or how they're treated, and they're often subject to withholding to non-U.S. investors. Similar, while reverse mortgages are pretty easy, there's these new forward option products where they give, not lend money to a homeowner, and then they take back a profits interest when they sell. Those have a real estate component. Those are really complicated if you have non-U.S. investors. And so not everything that looks like debt is debt, and you need to be careful because debt is really easy to sell to non-U.S. investors through funds or otherwise. But these sort of asset classes that have both an equity and debt component to it are much more complicated.
So we're blowing through our list of questions right here pretty quickly. Any questions from the audience? You're like, please let us out early. We can try to do that as well. I'm going to go off the sheet here, so apologize, guys. But it wouldn't be a panel on structured credit if we didn't talk about end of the credit cycle, how we're positioning for volatility. So how are you guys thinking about that? Maybe Amit, Kevin? Yeah.
Well, I think I've already mentioned what we are trying to do is develop these flexible account structures with our managers. What we found with them is this incredible opportunity set where the managers come to us with ideas that we did not even contemplate at the start of the relationship, but they're able to transact into. That has allowed us to take advantage of these strategies that pop up. Risk retention was not something that anybody thought about in 2012, but here we were discussing it with the first European CLO manager about to launch their first CLO 2.0. So, it was the flexibility of these accounts that's allowing us to continuously allow the portfolio that we run move along with the way opportunities come rather than wait for them to come to us. I think the other things that we're trying to do is build up these relationships where we're constantly out there looking for managers, looking for these counterparties who are out there doing things that we don't do, and trying to identify those, and that helps us as well. I think at the end of the day, what we're trying to solve for is a good yield return, and it's getting tougher and tougher to find. We have an oversupply of managers, a very strong demand for structured credit paper or credit paper of any kind, and what you have is a shortage of loans in the marketplace. It all leads to lower returns for everyone, and how do we sort of stay ahead of that curve to where we can still transact? Some of the things that we're doing today in the CLO space is we are less into CLO paper, and we're participating a lot more on the warehouses instead. We find that that's a better risk return profile and a much shorter duration rather than actually owning the CLO paper itself. So that's something that we're able to do with our managers and existing relationships. The other area is, of course, being a little more aggressive on the risk retention if somebody is willing to do that with us, with putting together terms that we think would put us in a better position from an underwriting perspective rather than take whatever the manager decides to put into their risk retention pool.
Yeah, I'd agree with everything that Amit said, but I think from more of a consultant's viewpoint, when we're trying to build portfolios for clients, it's funny, you go back 4 or 5 years and everyone was using the baseball analogy. Oh, we're in the 7th or 8th inning of the baseball game, right, which is the credit cycle. And if we had continued to use that, we'd probably be in the 15th or 16th inning by now. But going back, I primarily cover hedge funds as kind of the vehicle that we have used to access structured products. And 4 or 5 years ago, hedge funds, and even more recently than that, were really a 4-letter word. People hated them, they're too expensive, their returns aren't good enough, why am I not beating the S&P 500, which in the credit space is a frustrating conversation to have. But we've noticed in the past year and a half, clients are really seeing their hedge fund bucket as more of a capital preservation. And, we don't need to be, at least in the credit space, we don't need to, beat the S&P every year. Let's focus more on lower correlations to those markets, stronger emphasis on downside protection. So that's kind of a shift that we've seen as the environment's changed.
Sure. I'd like to add one more thing. So the other thing that we've actually done quite a bit of more recently is trying to find opportunities where we can buy assets and then put them through securitization through an ABS product. So, for example, we do own through an investment a fleet of airplanes that we've gone through. We've taken through 2 securitizations already. So that's another way for us to be able to do things differently than effectively just being a market price taker.
So I guess we'll do the parting shots and go down the line. Kind of what from each of your seats are the 1, 2 most topical things in your mind on the asset class, good or bad, and how you guys are talking.
First?
You don't have to go first.
No, I'll go first. I mean, I think in the CLO space, it's kind of bifurcating again the market between the IG CLO space and the below IG. The IG CLOs and the below IG CLOs, and we continue to see IG CLOs as probably the best risk-adjusted return that you can actually get in credit today. The caveat to that is it's like L plus 200, so that doesn't exactly get investors that excited, but on a risk-adjusted basis, it's pretty attractive, right? And then the below IG space, we're really seeing that as more opportunistic and playing it certainly in the mezz space more opportunistically, in the CLO equity space, trying to get our clients comfortable with CLOs is a whole challenge in and of itself. It's that kind of 3-letter acronym that people get a little shaky about, and those are conversations that we need to have and education that needs to go into the asset class. On the structured credit side or the more multi-sector space, again, I just touch on managers going out on the liquidity spectrum for yield and just being mindful and smart about how you're structuring your vehicles. I think we've seen it with a number of funds or firms that really started out as one fund, one firm, hedge funds, and now they're launching more private credit vehicles with 5 to 7 year lives. I think that's a great way to go out on the liquidity spectrum. You're leveraging all your infrastructure at your firm, hopefully, to do so, and you have a strong client base for which to kind of poach for that for those funds. So those were kind of the two topical things.
That's kind of typical duration that you guys look for, 5 to 7, and the drawdown side.
I would say in the securitized space, yeah, I think 10 years is a little probably too long. Where it would make sense for a distressed fund or a direct lending fund, I think 5 to 7 years is kind of what we're seeing.
Makes sense. Andy?
I mean, I don't want to sound pessimistic, but on the tax side, it's a little bit of a race to the bottom. I actually see opposite. I see banks and issuers pushing and pushing and pushing us to go, some of the safeguards that we've traditionally had in there to push away from them, to issue bigger bonds, higher yields, more product, because I think people are chasing yield and they just want to buy, and there's not as much out there. So, I mean, I'm glad you're sort of looking for those protections, but, I see a lot of things that, whereas people were more conservative 5 years ago, they're, way back to, pre-crisis in terms of pushing the structures.
So I guess it also wouldn't be a panel at this conference if we didn't mention LIBOR really quickly. But from a slightly different perspective, there's obviously been a lot of focus at the issuer level and at what their LIBOR fallback provisions are going to be in deals going forward, so that if they're outstanding at a time when LIBOR does transition, it actually works. The angle from somebody who's investing in a structured fund or managing a structured fund is a little bit different in the sense that you really need to start by looking at what your inventory is and what deals you have in your portfolio that are linked to LIBOR, and whether they're in fact legacy deals that don't have workable fallback language, or if they have fallback language, what is it actually going to push you to? And we've been talking to our CLO arranger and manager clients for a long time now about what the new deals should have in it, but we've only really recently started getting calls from folks on the investor side trying to kind of wrestle with their own exposure. If they are in a position of being able to have a lot of input on the terms of the new issue deals that they're going into, that's great. And they can kind of think a little bit about what their preferred approach would be, and see if they can get their deals as close to that preferred approach as they can. If they are not in that position, I think it's just kind of understanding the range of different options that they might be faced with, and whether certain ones are acceptable and certain ones are not. There's obviously been a lot of focus on people adopting some version of the SOFR waterfall approach that's hardwired. There have been some investors that are a little bit concerned about that, pushing them in potentially to a basis mismatch if the solution in the leveraged loan market is not SOFR, and so asking to have that modified with kind of a market check that looks at either whether the majority of the underlying assets have switched to that benchmark, or a majority of the paper that's issued in that space has switched to that benchmark, and that's great for new. And so that's part of the calculus for for deals you're investing in today. But if you're looking at your portfolio and you see a bunch of 2015 deals, 2014 deals that are still outstanding and maybe aren't in a situation where they're going to get refinanced, and they don't have workable fallback language, what's your solution to that? Is it something that you want to stay in? Is it something that you're going to hedge? Is it something you're just going to understand might be problematic and might have to be amended and might have to go through a painful process of finding consents? Just start thinking about what's there, because if you don't know what's there, you can't really come up with a solution. So we're seeing funds now starting to really focus on that, and I think that's a good thing. And it's something that we'll be seeing, I think, more more progress on over the next 6 to 8 months.
So, not being an economist of any sorts, not even trying to be one, people ask about where we are in the credit cycle and are we going to be in an inflationary environment or not. I think what we have is distortion in the markets going on. So when you're in an environment with interest rates as low as they are, your risk of defaults is not necessarily what you're looking for. What you're looking for is companies that actually, or credits that can actually survive in a much more normalized environment. And so with that, what we typically look for today is unnatural buyers of credit. So I know on the institutional investor side, a lot of the pension plans, endowments, foundations who are not natural investors of credit, they don't necessarily understand what they're owning. They have been participating, and they have been participating at a pretty decent scale. We just know that when there's fear in the markets, they are the first ones to leave. and they're the first ones to look for liquidity in the most illiquid parts of the market. I don't know why people do that, but they do it. And so we're hoping for, some of the distortion to translate into the credit markets where people actually have more fear built in, and we're able to step in and buy some good credits at better pricing than they are today. But there is not a single strategy that I can say is actually attractive. Everything's overpriced and certainly does not look attractive.
Great. Well, about 9.5 minutes left. Anybody have questions for our panel?
I can give you dollar amounts. The math would be, I would say it's close to about 500 to 600 million, so it's about 5%. A little bit more than that, a little less than that, sorry. Sure.
Any other questions? We'll give you back 9 minutes and 4 seconds of your time if there are no more questions. Thank you. Thank you to the panelists. Appreciate it.